Hello, everyone. This is Bob Lowe, CSIA Executive Director. Thank you for attending the October CSIA webinar. Today's webinar will improve your ability to understand all of your financial statements. As a reminder, use the Q&A panel to ask questions, not the chat panel. The host and sponsor of our monthly webinars is Software Toolbox, a CSIA partner member. Software Toolbox helps system integrators lower their risk on projects that involve software by providing them a unique mix of off-the-shelf software products and rapid response technical support that minimizes the need for custom code and lowers field startup time risk. I would like to introduce today's webinar presenter, Craig Billings, with Capital Valuation Group in Madison, Wisconsin, a valuation and litigation consultancy firm. Due to a death in Kathy Durham's family, she is not available to facilitate, so the format of today's webinar is different than that which was published. Craig is experienced at providing business valuation services as well as valuing various types of intellectual property and other intangible assets. Additionally, Craig is a damages expert and forensic accountant. His professional experience also includes public accounting and finance, and he has his MBA degree specializing in corporate finance. He is a member of both the American and Wisconsin Institutes of Certified Public Accountants and the American Society of Appraisers. So, without further delay, here's Craig.
Thank you very much. I hope that my first slide is presenting here. I do teach continuing education on a regular basis, but this is my first time doing a webinar, so hopefully I will be able to provide the same level of service and get accustomed to all the buttons and answering all the questions online. A bit of genesis to this presentation. My business partner, Kathy Durham, presented at the last national conference in Arizona back in April, and her subject was business valuation. And it's my understanding that her presentation was quite popular, and our firm was approached to see if we would be interested in doing a webinar. Kathy provided a number of different topics, and the one that seemed to be generating the most buzz was the topic we're talking about today, which is where's the money, what financial statements tell us and don't tell us. So it's largely based on accounting instead of business valuation. But in a way, it's quite an important topic because a lot of business valuation has to do with both accounting and finance. And my background specifically is in public accounting. I also have an MBA degree with finance. So I have a very strong understanding about financial statements. And one of the interesting things that we've learned with providing business valuations to small business owners, and one of the steps that we do in the valuation process is actually organize and lay out a series of historical financial statements side by side, typically up to 5 years. And inevitably, the owners have never seen their financial statements laid out like this. And it's a wonderful way to identify trends and identify anomalies in historic performance for the business. One thing we've also learned about doing this same exercise with the business owners is that many of them aren't familiar with cash flows. A lot of business owners do have their financial statements prepared, sometimes on an annual basis or perhaps more frequently, but oftentimes they don't understand them completely. They will look to the statement of operations, check their revenue, check the bottom line, maybe take a glance at the balance sheet, and that's about it. They're leaving out probably one of the most important financial statements, and we're going to get into that. So in today's presentation, I'm going to break it into a number of different parts. And please feel free, I'm going to try to do my best to keep on task. And if you do have questions, please feel free to input them in the Q&A panel, and I will do my best to try and answer them in line. If your questions come up later, we can also circle back and answer them at the end. But I will do my best to try and answer them with the topic that we're talking about. Today's presentation, we're going to talk about those 3 basic financial statements, which I just alluded to earlier. We're going to follow that up with an actual application of these financial statements and looking at a number of different scenarios about how changes in balances on these financial statements can affect your cash flows. We're going to follow that up with a discussion about the 2 most popular revenue recognition methods, and how they can be applied and illustrated in financial statements, and then wrap up the presentation with a brief summary and offer an opportunity for final questions. Moving on, part one, the 3 basic financial statements. So I'm sure that a lot of you as business owners have seen financial statements, and as I talked about earlier, there are 3 basic ones. The first one that a lot of you are familiar with is called the Statement of Operations. Historically, this is also known as the income statement or the profit and loss statement or the P&L or other colloquialisms. But currently in accounting lingo, it's known as the Statement of Operations. The second financial statement, which I'm sure that you're familiar with if you've looked at them, is called the balance sheet, the assets, liabilities, and equities. And the third statement is called the Statement of Cash Flows. And this is probably the most important, yet most underappreciated financial statement for a small business owner. Because, and well, I guess we'll talk about that. I don't want to spoil the fun. We'll talk about that when we get to the statement in a few slides. Let's start out with talking about the Statement of Operations. What is it? It's basically, you can think of it as a report card for your business, and it covers a period. And common periods are a year, sometimes quarterly or monthly, depending on how often you prepare your financial statements or how often you are required to prepare your financial statements. Most often, a lot of businesses are required to prepare them at least annually. And the Statement of Operations is it is a scorecard for the operations for the entire period. Let's assume that you had a calendar year end. The Statement of Operations would include all operations from January 1st through December 31st of that year. Quarterly and monthly, same format, but it's for activity during a specific period. What does the Statement of Operations tell you? As you've probably seen, the first line item on the financial statement, it tells you what your revenues were in terms of dollars. Now, as we're going to discuss later in the presentation, revenues are not necessarily cash. Revenues are a term for accounting, and it's largely based on accounting rules and regulations as to how to report those. Oftentimes on a Statement of Operations, right below the revenue line, you will see a section called Cost of Goods Sold and Gross Margins. This is where you would report your direct costs to produce those revenues. And for a lot of CSIA members, a lot of those costs would be labor costs. Below your gross margin would be the operating or overhead expenses. And some common operating and overhead expenses you might see for your business would be administrative wages, office expenses, postage, utilities, insurance, costs that will recur period after period but aren't necessarily related to directly producing revenues in terms of dollars. And finally, everyone's familiar with the bottom line. Hopefully, if your revenues less your costs are positive, you'll have a profit for that period. Otherwise, you will have a loss. So here is a very basic illustrated Statement of Operations. We start out with the line revenues. Subtracting the direct costs, as I mentioned earlier, a lot of those for the participants on this teleconference would be labor costs, leaving you with a gross margin. Subtracting from the gross margin, you have your overhead costs or your operating expenses, leaving you with a line item called EBITDA. And that is an acronym that represents earnings before interest, taxes, depreciation, and amortization. The reason why depreciation is not included in operating expenses is because depreciation is typically a non-cash expense, which we'll get into later. And oftentimes it can be manipulated, which we'll show in one of these examples coming up. But typically depreciation expense is broken out from operating expenses. So starting with our EBITDA, subtracting depreciation expense leaves a line item called EBIT, or earnings before interest and tax. Notice how it dropped the DA for depreciation and amortization. So from EBIT, we would subtract our interest expense to the extent that we have loans and are paying interest to arrive at the acronym EBT, or earnings before tax. If your company is a regular corporation or a C corporation, you might see the line item for an income tax provision, because regular corporations would pay income tax on their earnings. If your organization or your company is organized as a pass-through entity, such as an S corporation or an LLC or an LLP or a partnership, you would not see the income tax provision line. So either interest expense less income taxes results in net income or loss, or just interest expense subtracted from EBIT results in your net income or loss. The important thing about the statement of operations, it does tell you a couple things, including your revenue expenses, but most importantly, what does it not tell you? Probably the most important thing it does not tell you is how much cash the business generated. And realistically, isn't that what it's all about? Because cash is what pays the bills, and cash is what can be distributed to you as the owners for return on your investment. Not only does it not tell you how much cash the business generated, but it doesn't tell you how much cash the business spent, which is the flip side of that coin. And one thing it also does not tell you, a lot of people are confused by this, it does not tell you how much your company is worth. Kathy, as my business partner, did a presentation on business valuation back in April, and I believe she's going to repeat this in May, either a similar or a different presentation. But a lot of people will tell you can value your business based on a multiple of EBITDA or a multiple of income. I'm hopefully going to show you why that's probably not the best way to look at a value for your business. And the proper way to look at a value for your business is what cash it can generate. The next financial statement I would like to talk about is the balance sheet. So whereas the statement of operation was over a period of time, a balance sheet is a snapshot as of a specific point in time. So if our statement of operations for a calendar year company was from January 1st through December 31st, the balance sheet would be at the tail end of that, and it would be the balance sheet as of December 31st, or as of the end of a quarter, or as of the end of a month. It's always at the tail end of where your statement of operations ended up. Now, there's three important things that are shown on the balance sheet, and you can think of it as what the company owns, which are the assets of the company, what the company owes, the liabilities of the company, and what's left over is what the owner owns, known as equity. So, like the statement of operations, the balance sheet tells us a number of different things. And as you've seen, and I'm probably going to show this in an illustrated example in a couple slides, but some things that the balance sheet will tell you: how much cash does the company hold? Or how has cash changed if you have a comparative balance sheet, beginning a period and ending a period? You can tell if the company sells on account, or if it's cash basis. You can tell this by looking to see if there is an account or a general ledger account known as accounts receivable. If the company does not have a line item called accounts receivable, it's probably based on a cash basis of accounting. You're able to tell how much inventory is on hand. And for CSIA members, that would probably be mostly work in process of projects that have not been completed. You can tell how much equipment, machinery and buildings, and other fixed assets the company owns. You can tell, flipping over to the liability side, how much in terms of liabilities needs to be repaid within the next 12 months. And the liabilities that need to be repaid within the next 12 months are called current liabilities, not surprisingly. Also, over on the liability section of the balance sheet, you can see how much needs to be repaid in the long term, non-current liabilities. And typically, the most common long-term liability we'll see on the financial statement is called long-term debt, or bank debt that will be amortized over a number of years, 3, 5, sometimes longer, if it's tied to a building mortgage. Continuing on, some other things that the balance sheet will tell you. Getting down to the equity section, it will tell you about the profits that have been retained in the company. Going up to both the assets and liabilities, it will give you a snapshot of what the liquidity of the company's assets are called, or what the liquidity of the company's assets are. This is known as the current ratio. And I'll illustrate that on some of the coming financial statements. But the current ratio is simply the current assets less the current liabilities, or that ratio between current assets and current liabilities. It's a good snapshot of what the company's liquidity is and how quickly it will be able to repay its current debt. A balance sheet can tell you how capital intensive the company is. If you see a lot of property and equipment or a lot of buildings on the financial statement, you can tell that it's a capital intensive business. Probably a lot of the participants on this phone call do not have very capital intensive business. They might have some furniture and fixtures, some computers and electronics, but they probably don't have a lot of heavy machinery, a lot of buildings, or other expensive assets to produce the revenues that their businesses do. And the balance sheet can also tell you the amount of the financial leverage in the company's capital structure. And by that, I mean how much debt is there on the books in proportion to equity. A lot of companies actually have very little or no debt. Some companies do employ debt in their capital structure. We'll talk about that and the effect it has in some upcoming slides. So here is an illustrated balance sheet, very simplified. The first section you'll see on almost every balance sheet is, at least typically, it starts out with the asset section. And the first section you'll see are the current assets. The balance sheet is typically ordered in order of liquidity. So even within the current asset section, items will be ordered in terms of liquidity or in terms of when they will be acquired or disposed. So obviously cash is the most liquid asset on the company's financial statement. That appears first. Other common assets that you'll see in the current assets section are accounts receivable, inventory or work in process. Sometimes you'll see prepaid expenses on there. Those are probably the most common current assets you'll see. Following current assets, you typically see the property and equipment section, or fixed assets. I've summarized it here, but some of the common categories are computers, machinery and equipment, furniture and fixtures, buildings, leasehold improvements, occasionally vehicles. Those are reported at their book value or acquisition value. And subtracted from that is called a contra asset, known as accumulated depreciation, resulting in the net book value of the property and equipment. So the sum of the current assets plus the property and equipment, and occasionally you will see a section with other assets such as investments or other long-term assets that aren't property and equipment. That sums up to be total assets, in this case, $500. The next page has the other side of the balance sheet, which is the liabilities and equity. And just like the asset section, it is ordered in terms of liquidity, from most liquid liabilities first to least liquid liabilities second. So we have the current liabilities section first. Some common current liabilities you will see on your financial statements are accounts payable and accrued expenses. They're very similar. It just depends on whether it's a payment for goods and services or a recurring expense. Sometimes you will see unearned revenues or billings in excess of costs. We'll illustrate some of those in some upcoming slides. Current liabilities, long-term debt is the long-term liabilities, and typically you might see this where it is the current portion of long-term debt may be moved up into the current liability section, and the actual long-term debt might be a net. That would be the net amount that will be paid outside of one year into the future or one period into the future, depending on. Current liabilities plus long-term liabilities, total liabilities. The other part of the equation here on this side of the balance sheet is the equity section. So where we had assets, which is what the company owns, liabilities, what the company owes, and the remainder, or the leftover, is the equity. And that's what's left over for the owner of the company. That is their net investment, what remains after that period of operations. And as you can see, total liabilities plus total equity, $500. Same as over on the other side of the balance sheet. And that's probably the most important thing to know about the balance sheet is that there is a common equation. Assets equal liabilities plus equity, always. They have to. So the total assets always have to equal total liabilities plus total equity. And the way to look at that is, we talked about this earlier, business owes creditors for the loans made and other liabilities that it has either purchased in goods or incurred in terms of services. The business owes the owner for anything that's left over after the liabilities are paid, and it owes the owner for any profit that is realized from the business operations. So assets equal liabilities plus equity. It's probably the most important thing to know about the balance sheet. Another point about the balance sheet that a lot of business owners get confused about is retained earnings. So what are they? Retained earnings are simply just the leftover. Stepping back a few slides, we talked about the statement of operations, which is for a period of time, say from January 1st through December 31st. That results in either a net income or a net loss. To close out that period and start a next period, so imagine January 1st of 2013, you would close out the statement of operations by essentially moving that net income or loss number over onto the balance sheet, and that either increases or reduces retained earnings, depending on whether it is income or loss. So in reality, it's simply the net income that the entity has kept in the business. It is essentially, as the slide says here, it's the income that is retained within the company that has not been paid out to the owners through either drawings or dividends, depending on the type of entity that you own. We talked about how to close out the books. The net income or loss is essentially moved over and offset against the beginning retained earnings amount to result in ending retained earnings. And probably a very important thing that a lot of people get confused about is that retained earnings has nothing to do with cash. It's not cash that's left within the business. It doesn't have anything to do with cash. It's basically just a clearing account for what's left over off the statement of operations. So if you learn anything about retained earnings is not cash. You can't take retained earnings to the bank. You cannot cash it out. Just like the statement of operations, there's certain things that the balance sheet cannot do. What does the balance sheet not tell you? It doesn't tell you what your net income or loss for the preceding period was. That's the job of the statement of operations. It will tell you the accumulation of the preceding period's income or loss as it affects retained earnings, but that can actually be affected by distributions that have been taken out by the owners or additional cash put in. Another thing the balance sheet does not tell you is what is the fair market value of the assets and liabilities of the company. Obviously, there are certain things that are probably fairly close to fair market value. Cash is cash. Receivables, to the extent that they're fully collectible, is probably fairly close to fair market value. But fixed assets are probably not stated at their fair market value. Fixed assets are placed on the books at historical cost, and they are reduced by an arbitrary number called depreciation expense. The leftover amount or the net fixed assets is probably not what you could get if you went out and sold them. Another reason, there are actually assets that the company owns that aren't on the balance sheet, typically, intangible assets. In the case of a lot of participants on the call here, probably the most important intangible asset that the company owns is a trained and skilled workforce in place. I would bet that your workforce is not appearing on any of your balance sheets, yet it's probably your most important asset and the most difficult to replace. And another thing the balance sheet doesn't tell you is how much your company is worth. And I have an asterisk in there because there may be some situations where it can tell you how much the company is worth, such as if the company goes bankrupt and is in liquidation, it can probably approximate what your company is worth if you had to sell the company in an orderly liquidation. But for an ongoing continuing operation, the balance sheet is not a good indication of value for the reasons I talked about earlier. A, that a lot of the assets and liabilities are not stated at their fair market value, and there are several off-balance sheet assets, such as intangibles, which significantly add to the business's value. We mentioned workforce in place. Another one would be goodwill. Typically, you don't see those on the financial statements, but yet they're probably a very important part of your business's value. The next statement, and as I alluded to earlier, probably the most important yet most underappreciated financial statement is the statement of cash flows. And why is it most important? Because especially for a small business owner, cash is king. So the statement of cash flows is a summary of all the cash receipts and cash payments of a business for a specific period of time. The same period of time is your statement of operations. For example, January 1st through December 31st. And the purpose of the statement of cash flows is not only to tell you where the cash came in and out, but it is also an excellent tool for reconciling the beginning and ending balance sheet. You can look at your balance sheet on January 1st and look at your balance sheet on December 31st, and the statement of cash flows will illustrate how those balances changed from beginning of year to end of year. Typically, there's 3 sections on a statement of cash flows, and they each have their own specific purpose. The first section you'll see is the cash generated from operations. And this section will show the cash generated from the company operating during the period, and also the changes that were needed in working capital for the company to run during that period. Following this, after the company has essentially invested in itself by increasing working capital in terms of a growing company, we'll have cash flows from investing activities. And typically, this is cash you will see that will be used to, oftentimes, the most common item you'll see is purchasing property and equipment and other non-current investments to the extent that you'll see them there. So the business has run, it's generated cash from its operations, it's reinvested in itself by adding to its working capital in order to operate for the next period. It's purchased capital equipment or capital expenditures in order to grow or replace property and equipment that is worn out. Now you have the cash left over to pay the stakeholders in the company, and this is cash flows from financing activities. Those of you who have debt know that the first person who gets paid is the bank. So you'll either, in this section, you will see cash inflows to the extent that you took out a loan, or cash outflows to the extent that you've paid down loans via debt service. To the extent that the business has extra cash that it doesn't need to retain in the company, it can make distributions to the owners. So cash flows from operating activities, followed by cash flows from investing activities. Bottom line, left over is cash flows from financing activities. I talked about this a little bit on the earlier slide, but the cash flows from operating activities is the cash generated by the business doing what it does. In the case of a lot of CSIA members, providing services generally. The main link to the balance sheet from the cash flows from operating activities are going to be primarily the current assets and the current liabilities over on the balance sheet. And as I talked about earlier, current assets in excess of current liabilities is known as working capital. And as a business grows, it typically needs to increase its working capital in terms of additional cash on hand. If the business is growing, receivables are likely to be growing. As the business grows, payables and accrued expenses are likely to grow. So by looking at this cash flow from operating activities, an astute business manager or owner can look at the changes from the statement of cash flows and notice if anything is out of whack. And we're going to talk about that in some of the examples coming up. But if you see that the cash flows from receivable or cash flows from receivables or inventory or accounts payable have increased or decreased dramatically, you can see how the direct link is to how the business's cash is at the end of the period. The other thing to mention about this cash flow from operating activities section is that it specifically identifies non-cash revenue and expense items. And probably the most common non-cash revenue and expense items you will see on your statement of cash flows is depreciation expense. Depreciation expense is an expense, but it is only an accounting entry. It has nothing to do with paying for equipment. That's done when you buy it. It has nothing to do with disposing of equipment. That happens when you dispose of it. It is basically either an economic way to recognize that equipment depreciates in economic value over a period of time. And the more confusing part is that there are different rules for book accounting, or generally accepted accounting principles, or GAAP, and tax accounting, which allows you to depreciate items faster than economically viable. We'll talk about that in an upcoming slide as well. So here is an illustrated, very simplified cash flows from operating activities section here. Starts off with our income before interest and taxes, EBIT. And to the extent that your company is a regular corporation, there would be a tax provision on that. In this case, it's about 33%. We're going to add back any non-cash income or expense items. In this case, we're adding back depreciation expense because it is a non-cash item. We're going to see that receivables increased by $200, which means that you did not collect that $200 in cash. So that's a decrease in cash flows from the beginning of the period. You reduced your inventory value, so there was some cash inflows from inventory. You decreased your payables. You paid off your bills, reducing cash by $300. Your accrued expenses increased by $100, meaning that you have some outstanding bills to be paid, such as utilities or property taxes. And we have some unearned revenue, which we'll talk about in some of the upcoming slides. So starting off, we have the company was, you can think of this earnings before interest and tax. So this shows that the company was profitable in the case that earnings before interest and tax was positive. After adding back the non-cash items and the changes in working capital, we're showing that the company generated $300 in cash from operating activities for the period. Next section is cash flows from investing activities. As we talked about earlier and a few slides back, typically the most common item you'll see on your financial statement is the sales and purchases in terms of cash of property and equipment, known as capital expenditures. And sometimes you will see investments on there. If you have notes receivable from shareholders or other loans receivable or other investment accounts, if you're parking your excess cash somewhere. The link to the balance sheet that you'll see from the cash flow from investing activities is typically, as I mentioned, over in the property and equipment section. It's the change in the fixed assets and the non-current assets to the extent that you have those. And here's a very simplified but illustrated cash flows from investing activities, but oftentimes there just aren't as many line items in there. In this case, what it shows is that the company purchased an additional item, property and equipment, for $100, and they used cash for it. So cash flows from investing activities, a cash outflow of $100. Now, taking a break here and divesting a little bit from the accounting presentation, I'd like to talk about cash flows and valuation. So we talked about cash flows from operating activities, followed by cash flows from investing activities. That results, for valuation purposes, we look at that, and the sum of those two numbers is called invested capital cash flows. Sometimes you might hear it called free cash flows. And basically, this is the cash that's available for the other stakeholders in the company. As I mentioned before, the bank gets paid first, and then if there's anything left over, the owners get paid. And so in general, to the extent that you have greater invested cash flows, invested capital cash flows, that will typically result into a higher business value to the extent that you can maintain invested capital cash flows at this level into the future. When we look at valuation, this is one of the key metrics we look at. How much cash is available? Because if you're buying or investing in a company, you're interested in your return on investment. And your return on investment is in terms of cash. Cash is king for the small business owner. So back to the accounting. We have the third section on the statement of cash flows from financing activities. And as I talked about earlier, this is basically the net of any borrowing activity. Both cash flows can be inflows from financing activities to the extent that you took out a loan, or it can be an outflow to the extent that you had debt service, both principal and interest. And after that, as I mentioned, to the extent that the business does not retain the cash in the company and it makes a distribution, you will see either withdrawals by the owners. Sometimes there might be a shortfall, and the owners need to put cash back into the company. That would all be in this section. And as I mentioned before, the cash flows, statement of cash flows reconciles the balance sheet. In this case, the link is typically in terms of the long-term liability section and the equity section. You'll see that being reconciled down in the cash flows from financing activities. And here we go, an illustrated cash flows from financing activities. Here, change in long-term debt. What that shows is that the business had a loan. It was paid down $100 in principal. The company also paid $100 in interest expense. To the extent that you're a regular corporation and the corporation pays taxes, because interest expense is deductible, there is a tax effect, essentially a negative tax effect by being able to deduct interest expense on your taxes. And it turns out that the business did not need as much cash as it did at the beginning of the period, so it was able to distribute $133 to the owners. The net of this is cash flows from financing activities, cash outflow of $300, made primarily based on payments to the bank and payments to the owner. So just as with the statement of operations and the balance sheet, the statement of cash flows, there's some, even though it's a great statement and probably the most important statement for the small business owner, there are certain things that it can't tell you, and you need to look back on the other statements. It doesn't tell you what is the liquidity of the company, you know, what is the mix of current assets and current liabilities, and if you get into a cash crunch, how quickly can the company liquidate its working capital. Even though it tells you the cash impact of your assets and liabilities, it won't tell you what is the mix of assets and liabilities, or to the extent that the company has debt in its capital structure, or to what extent it has. Other than that, it's a pretty useful tool for the small business owner. So moving on, now that we've learned about the three primary financial statements, we're going to apply those and see how different financial scenarios actually impacts the cash that the business has. The first scenario, you're having problems with collection. Let's say your business has a great period, very profitable and strong net income. You bill your customer, or you didn't bill the customer, but what happens is your accounts receivable balloons. There's a lag in collections. Why does this happen? Any number of reasons. It could be that you didn't make out your, you didn't bill your customers timely, and if you don't bill them, obviously you can't collect. Or it could be that you billed them, but they were a bit too slow to pay, and you didn't have either yourself or your office manager or whoever does your collections stay on top of your customer, sending out statements and inquiring when they might be able to pay. Or it could be that you did work for a customer who is in financial trouble, and all of a sudden they're out of money, and they can't pay their bills. And if they can't pay their bills, they can't pay you. Any number of reasons why accounts receivable could balloon. But how does that affect your cash? So we have a beginning of period and an ending period balance sheet here, time 0 and time 1. So we started off the period with $800 in cash. We billed our customers, we did great work, and we were profitable for the period, but yet we still had $1,700 outstanding that the customers, either we haven't billed them or it hasn't paid yet. As you can see, we're experiencing a cash crunch. Cash has gone from $800 down to 0. How does that impact, how does that illustrate it on the statement of cash flows? So yeah, look, we had a great period. Our earnings before interest and tax, or EBIT, $600. Depreciation expense, non-cash. Whoa, receivables ballooned. $1,700 increase in receivable means $1,700 that we did not collect in cash. So that's a decrease in cash flows. Cash flows from operating activities, even though we had a really profitable period, $600 of EBIT, the net result is that our cash flows from operating activities, negative $700. So how are we going to make up for that? Well, we still have to pay the bank. They're going to demand that we pay our principal and our interest. And the result is we had a cash outflow. We can't really have, unless we had a line of credit, our cash can't go below 0. So the owner had to put in an extra $167 out of his or her own pocket in order to true up the cash, just to keep the business afloat at 0. So to summarize, the inability of the company to collect the cash timely results in negative cash flows from operations, resulting in a cash crunch down to 0. And in order to make up for that cash crunch, the owner had to put in some of his or her own money. Example 2, and this one is related to capital expenditures, and we're going to actually have 2 examples to show you the difference between paying for capital expenditures with cash or paying for them with debt. So again, we have our example here. We had a great period, strong net income, and we're expected to grow over the next period, and so the company needs to buy some new property and equipment. In valuation lingo, we call that capital expenditures or CapEx. In this case, the business owner purchased the CapEx with cash. This could be for any number of reasons. Either the company had a lot of cash, or the owner just doesn't like taking on debt. We see that a lot with small business owners. Or perhaps they just couldn't get a loan from the bank or the financing company, depending on where they bought the property and equipment. In any case, the CapEx was purchased with cash. So back to our example here, we have time 0 and time 1. We started off the period with $800 in cash. Receivable is not an issue in this case, but as you can see, we started off with $400 of property and equipment, and we purchased another $1,000. So our property and equipment balance increased from $400 to $1,400. How does that impact, or how is that illustrated on the statement of cash flows? So again, great period, profitable period. No real problems with working capital or other non-cash items. We still have positive cash flow from operating activities. Probably a little bit of work to do with receivables collection, but you're still cash flow positive after this point. We purchased the property and equipment or the capital expenditures with cash. So that's a $1,000 cash outflow. As you can see, cash flows from operating activities, less cash flows from investing activities, negative invested capital cash flows. So that's a cash shortfall that has to be made up somewhere. As we know, we started off the period with $800 in cash, so we might be okay, except that we had to pay the bank. We had to pay our debt service, and that wiped out basically everything else. So the owner had to put in $167 of his or her own cash contributed back into the company just to maintain the cash at 0 at the end of the year. The next example, also capital expenditures, same scenario, profitable period, significant investment in CapEx. The difference is this time is that instead of paying for it with cash, the capital expenditures was financed with debt, either through a loan from the bank. Oh, let's see if we have a question here. I have a question here. Would any of this approach change if you were a C Corp or an S Corp? The difference would be, the main difference between a C Corp and an S Corp, getting back to the statement of operations, recall that a C Corp has a double layer of taxation. So any profit or loss from the business has to pay tax at the corporate level, or it takes a loss at the corporate level. Then, to the extent that it makes distributions to its shareholders, those are again taxed to the shareholders of the company as dividend. So for a C corporation, there are 2 layers of taxation. The income is taxed first at the corporate level, and then to the extent that is distributed to the owners in terms of dividends, it is taxed a second time. S corps, LLCs, LLPs, partnerships, any of those pass-through entities, you would typically not have an income tax line on your statement of operations because those entities do not pay tax themselves. You may recall that if you're a business owner of a pass-through entity, you get a tax form called a Form K-1. And the Form K-1 is your proportionate share of the company's taxable income or loss, which you then report on your own income tax return, your 1040. And typically that goes on Schedule E, page 2. That's really the only difference that would affect any of the previous slides in terms of regular corporation or pass-through entity. Cash basis versus accrual basis. To the extent that a company is cash basis, you would not have a line item for accounts receivable, so that would not be on there, and you would also not have a line item for accrued expenses, which is the current liabilities equivalent of accounts receivable. you would, if you were a cash basis company, you would only recognize, you wouldn't recognize receivables. You would still send out bills, but you would not recognize it as a receivable until it was collected and deposited in your bank. Likewise, to the extent that you have bills that you need to pay, such as utility bills or property tax bills or other recurring expenses, you would not recognize those as an expense until they were paid with cash from your bank. So that's basically the difference in these previous slides, C Corp versus pass-through entity and cash basis through accrual. Otherwise, all these same principles apply. Hopefully that answered the question. If it didn't, please feel free to write another one. So here we were getting back to example 3, CapEx. Same as example 2. Profitable company, bought some property and equipment. This time it was purchased not with cash but with debt. Either the company got a great deal on the financing, interest rates are really low right now, so it's probably a good idea, or the company decided to add some leverage in its capital structure to off some of the risk from the business owner over to some of the debt holders. And it's often ideal, especially from a valuation purpose, to have some leverage in your capital structure. It reduces the risk for the business owner to the extent that, at least to the extent that debt is not excessive. So similar to what we had before, we have property and equipment went from $400 to $1,400. We can see that that was purchased with an increase in debt. So long-term debt went from $400 up to $1,300. Obviously, it's not a one-to-one because some of the debt was paid off. The important thing to recognize, though, is that the level of cash stayed the same. Was $800 at the beginning of the period. Because that $1,000 in cash was not used, or because that $1,000 purchase was used with debt, cash was not used. How does this translate into the statement of cash flows? Profitable period, cash flows from operating activities look good. We did purchase some property and equipment, but it's not done with cash because there was an increase in long-term debt. So you can think of these as almost offsetting. The reason why it's not one for one is because there was some debt service during the year. The net result is that there was plenty of cash left over. In fact, a little bit left over that the owner could make a distribution to themselves of, well, a meager $33, but that's better than putting in money. The important thing to note is that cash at the beginning of the year and cash at the end of the year stayed the same, and the owner was able to take a return on investment. Example 4, I talked about this a little bit earlier, depreciation expense. The important thing to note as a small business owner is that depreciation expense is just an accounting entry. It doesn't have anything to do with cash. So we're going to look at a scenario about, and I also mentioned about how sometimes for tax purposes you can take bonus depreciation. It's also known as Section 179. And oftentimes you can effectively depreciate the entire amount in the year that it's purchased versus having to depreciate it over 3 or 5 or 7 years. So in this scenario, we're going to have the same company, the same investment in CapEx. The company was profitable and is able to elect bonus depreciation, Section 179. And we're going to see how this results in a net loss for the company. Wow. So how does this affect the cash flow for the company? So as with before, we see that property equipment purchased $1,000. Depreciation expense, or accumulated depreciation, as you can see here illustrated by the contra asset, also went up by $1,000. So effectively, this year's purchase was fully depreciated in this year. How does that affect cash flows? First of all, let's look at how it affects revenues. As I mentioned before, it's a big hit on revenues, depreciation expense, even though it's a paper or accounting entry. Great revenues, nice gross margin, strong EBITDA. Wow, we have $1,100 of depreciation, which is $100 from our previous assets that we held at the beginning of the period, plus an additional $1,000 from the fixed assets this year. Results in negative earnings before interest and tax. We still have to pay the bank, so we have interest expense. This results in a net loss, at least earnings before tax, of $500. Because we had a loss, if we're a regular corporation, we are able to get a carry forward, and in effect we have negative tax provision. But in any case, we have a loss for the year, primarily because we excessively depreciated our assets. And it's perfectly legal. I'm just showing the illustration about how that can affect it. So great period, very profitable, great margins, yet a net loss. How does that illustrate it in terms of cash? So we have our EBIT. In this case, it's a loss. Because it's a loss, we have a tax carry forward. But we're going to add back depreciation expense because it's a non-cash item. Working capital, nothing really to talk about here. But as you can see, even though we showed a loss on the books, we're showing positive cash flows from operating activities, mainly because depreciation expense is a paper entry, has nothing to do with cash. So those are examples about different scenarios where different items can affect either increase or decrease the cash we have on hand. In the time left, I would like to quickly run through some of the two basic revenue recognition methods. And I probably won't be able to do this justice, but I will do the best effort that I can. The main thing when we're talking about revenue recognition is the matching principle. So we want to match the revenues during a specific period with the expenses that were used to generate those revenues. So in the case that a company would have cost of goods sold, in the case where it has inventory or work in process, we're going to try and match the appropriate cost of goods sold on the statement of operations with the revenues that are recorded. And when I say revenues that are recorded, I say that because revenues recorded on the financial statement are not necessarily the revenues generated, which is going to lead us into some of the slides coming up. But it's also important to recognize that the costs related to the overall operations of the business, including your overhead expenses, such as your administrative expenses, your office expenses, your postage, your utilities, those expenses are going to incur whether you had $1 of revenue or $1 million of revenue, and you'd still recognize those expenses on your statement of operations. So overhead stays the same. It's the cost of goods sold that needs to be matched up with the revenue, depending on the type of revenue recognition method that you are employing. The first one is known as the completed contract method, and it's quite possible that a lot of you in your businesses use this methodology, primarily because it's simple to use. Basically, the revenue that you report in your financial statements is based on the revenue that you incurred or that you earned for your job. The difference is, as opposed to making estimates of any unperformed work. The problem is that if you have a long-term project that spans one or more accounting periods, and it could be more than 1 year or more than 1 quarter or more than 1 month, depending on how quickly you are performing your financial reporting, it can distort your reported income and expense. And I'm going to show you an example about that coming up soon, after I introduce the other method of revenue recognition, which is called percentage of completion. Ideally, this is the way to go because it most mirrors economic reality. It allows you to report revenues and expenses in the period that they are either earned or incurred, depending on. The problem is that in terms of a project that is not completed by the end of the period, you need to make a reasonably accurate estimate about how much effort it will take to complete the project in terms of revenue and expenses. Oftentimes, if you are working on a bid contract, you know what the final revenue number is going to be. The trick is to try and estimate what your future costs are going to be to earn this revenue in future periods. The most common way to do this is called the cost-to-cost method. And it's fairly simple. Basically, the way to look at this is on your statement of operations, if you are using the percentage of completion method, the amount of revenue and gross profit that will be recognized is going to be a fraction of the cost that you've incurred to date divided by your most recent estimate of the total cost to complete the project, however many periods it will take into the future to finish it, multiplied by the estimated total revenue, or if you're estimating costs, it would be multiplied by estimated total gross profit. You're going to subtract any revenue previously recognized, or to the extent that you're estimating gross profit, any gross profit that's been previously recognized. And that is going to be the current period revenue recognized on your statement of operation, or the flip side is the expense side, current period gross profit recognized on your financial statement. So let's run through two quick examples here. First one is going to be completed contract. And this is going to be a contract that's going to be spanning over 3 different periods. So in period 1, let's imagine year 1, but we're going to say period 1. We've incurred $2,000 of cost to date. We've billed our customers $1,900, of which we've completed $1,700, or which we've collected $1,750. And as of the end of the period, the project is not complete. We've bid it out for $5,500. How does that impact on the financial statements? Well, we know we've billed $1,900, we've collected $1,750. That leaves $150 yet to be collected. We know that we've incurred $2,000 of costs. That goes as part of our work in process. Because we're on completed contract, we can't recognize the revenue until the project is complete. So we have a line item in a financial statement known as unearned revenue. And this is going to accumulate until the project is completed, at which time we will zero out that account. How is that affected by the statement of operation? Well, we didn't complete the project in year 1, so we have no revenues. We also can't recognize any cost of goods sold. We still have to recognize our operating expenses and our depreciation and our interest. The net result is, for the period, that we're going to show a $200 loss for the period. Now, that's probably different from economic reality, because we did know that we put in we billed $1,900 and we put in $2,000 worth of expenses. Yet this is how it would be illustrated on our statement of operations if we were in completed contract. Moving on to period 2. We incurred another $916 of expenses, making our total expenses $2,916. During this period, we billed customers $2,300 and collected $1,150. Still, at the end of the period, the project is not complete. Still, we're stuck to our bid price of $5,500. How is that illustrated on the financials? Based on what we billed the previous period, less what we collected, plus what we billed in this period, less what we've collected, we have $1,300 in receivables left over. Our work in process has increased to $2,916 based on the cost to date. At the end of last period, our unearned revenue is $1,900. Now it's $4,200. Project isn't complete, so our unearned revenue remains as a line item on our financials. Again, project isn't complete, so we can't recognize any revenue or any cost of goods sold, but we do have to recognize the overhead and period costs, the operating expenses, depreciation expense, interest expense. Again, we had a great period, we did a lot of work, we billed our customers, but our financial statement shows a loss, $200. Period 3. So now we have accumulated cost to date of $4,050. We billed our customers $1,300 during the period, and we collected $2,600 from them. The important thing to note is, finally, the project is complete in period 3. How is this illustrated on the financials? We collected everything that was billed during the period. That's great. Our inventory and work in process, the project is complete, so now there is no more work in process. The job is done. We had unearned revenue previously. Now we've earned it because the project is done. Unearned revenue went from $4,200 down to 0. So what a great statement of operations for period 3. We get to recognize, even though we've been working on this for 3 years, we now recognize the full amount of the revenues, the full amount of the cost of goods sold. This is our margin. We have period 3 operating costs. And whereas in previous periods we recognized net losses, now we recognize the full amount of the income, $767 in period 3. So your financial statements look terrible for periods 1 and 2, but they look great in period 3. Kind of, as I mentioned, that's kind of a distance from economic reality, because really you were doing great business in period 1 and 2 and 3, but your financial statements, at least the statement of operations, do not illustrate that. So how does this all play out in terms of cash flows? So this is periods 1, 2, and 3 cash flows. We can see our EBIT was negative for periods 1 and 2, positive for period 3. We can see the fluctuations in our working capital. Positive cash flows from operating activities in years 1, 2, and 3, especially in period 3 when we collected most from our customers. And probably the most important part is that we had to maintain our cash balance, but because we did so many collections from our customers in the last period, we were able to take an owner distribution of $767. So cash at the beginning of this project started at $800. We ended up with $400, and the owner got a return on investment of $767. Percentage of completion example. I know we're running short on time, but I feel it's important to illustrate this, and I'll try and do it justice. So percentage of completion, recall that you have to estimate where you are at in a project to the extent that it's not complete. So we're going to have the same project. Period 1, we incurred $2,000 of costs. We billed customers $1,900. We collected $1,750. At this time, at the end of year 1, we were estimating that our total costs for the project were going to be $4,000. Based on this, we are estimating that our project is half complete. And we do this by our cost to date of $2,000, our total cost of $4,000, we're estimating 50% complete. How does that play out in the financials? We know that we billed $1,900, we collected $1,750, that leaves $150 of receivables. Cost in excess of billings. We know that we've incurred $2,000, and we've billed $1,900, and less our collections leaves $850 for cost in excess of billings. This is a little bit different than what we saw on the completed contract method, and it has to do with the estimate of cost to complete and the estimate of costs that have been incurred to date. On the liabilities, well, let's see. Actually, there really isn't an effect on the liability side. But the difference is in period 1, we get to recognize if our total project was $5,500 for the bid and we estimate that we're 50% complete, we get to recognize 50% of the revenues and 50% of the costs for this period, including all of our period costs, resulting in a net income for the period of $300. Recall that with completed contract, our net loss for the period was $200. Period 2. We incurred an additional $916 of costs. We billed customers $2,300. During the period, we collected $1,150. But now, at the end of period 2, we realized that our costs are going to be higher than we originally estimated. So costs have been revised upward to $4,050 from $4,000. Based on this, based on the costs we've incurred so far, we estimate that the job is 72% complete. How does this play out in the financials? Well, we know that we have $1,300 of receivables left to collect, but now we've billed customers for more work than we've done. So instead of costs in excess of our billings, now it's flipped over that we have billings in excess of our costs. How does that play out in the statement of operations? Again, we get to recognize 72% of the revenue. We already recognized 50% in the previous period, so it's an additional 22% of the revenue and expenses in period 2, resulting in a small net loss for the period. It wasn't as good of a period from an income expense side as period 1. Period 3, we incurred additional costs of $1,134. We hit our estimate of $4,050. We billed our customers $1,300 and collected everything, $2,600. And importantly, the project was completed during the period. Our costs, $4,050, total costs, 100% complete. How does that play out in the financials? We collected all our receivables, done. We billed the exact amount of what we were supposed to, so billings in excess of costs, now gone. Revenue, we know that our total revenue for the project was $5,500, less the revenue we've recognized in previous periods leaves us to recognize $1,540 of revenue this period and an appropriate amount of costs. Keep in mind that the revenue recognized has nothing to do with, well, it's loosely related to, but not exactly related to the actual work done during the period. It's completely based on the amount you can estimate that the job is complete. So in this case, this is what was left over from our estimate on the bid and the costs. Results in profit for the period of $71. How is this illustrated in the statement of cash flows? You can see, whereas in previous periods we had loss, huge income, now we have more even earnings before income and tax. You can see the effect on the working capital of uses and receipts of cash. Small cash outflow from operating activities, huge cash inflow because we billed so much in that second period, and an amount in the middle for the third period. It results, this more even cash flow allows us to make distributions to the owner of $300 in year one, $96 in year two, $371 in year three. Whereas in the previous issue, or the previous example under completed contract, we were required to maintain enough cash and we could only make a distribution after year three. The important thing to note is that cash at the beginning of the project, $800, $400 at the end. Here's these side by side. I'm sorry if they're somewhat small, but you can see how the difference is between the two methods. Over here on the left is completed contract in the orange, and over here on the right is the percentage of completion. So you can see the difference between, you did the same work on the same project, but you can see how different accounting methodologies result in wildly different financial presentations. Losses, big gain, steady gain. Change in working capital, fairly steady over here, a little bit more erratic over here. Able to take a large distribution in year three versus being able to take more even distributions over here. The important thing to notice is that it's the same project, same work, different accounting. Started with $800 at the beginning of the project, ended with $400 at the end of the project. Okay. That's all the material I have for today. I'm sorry I ran over, but I do have to provide a message from our sponsor. CSIA has asked that we remind you about the business statistics program called KPICS, KPICS, that provides financial analysis and industry benchmarking services as a way to track trended financial performance and compare metrics against others in your industry. This program allows the participating CSIA members to upload their financial statements to a trusted repository and allows them to remain anonymous in order to compare with other fellow CSIA members. If you are interested in KPICS, contact CSIA for more information. And with that, I'm sorry I ran over, but I believe I would like to entertain any final comments or questions that the participants may have.
Okay, thanks. It was a very, very informative presentation. Even as the technical host, I enjoyed this. I have a couple of questions. I have one person on the phone who I have unmuted. There is one question that was posed in chat. It goes all the way back to your first statement of cash flows example, and it was, are the receivables in the example shown on the statement of cash flows as negative? I think maybe it was an understanding why they were shown as negative. Maybe you just want to jump back to that slide.
The very first example.
Yeah, way back in there in your cash flows.
Right here? Oh,
yeah.
Right. Okay. I can see. It is shown as negative because the way this works, and you can't see it from this example, and perhaps I will flip forward to, right, someone just came in with a comment, it's an unfavorable change. Basically what this means is that your receivable balance increased from time 0 to time 1, which means effectively that you billed customers, but you collected $200 less than you thought you would. Receivables balance increased, and to the extent that it's out there in the receivables, that means it's not cash in your bank account. So an unfavorable change in any current assets will show as a cash outflow. On the flip side, you can also see down here, accounts payable shows a cash outflow of $300. Basically, what that means is your accounts payable balance at the end of the year was $300 less than the accounts payable balance at the beginning of the year. Basically, you paid your bills faster. Would it be possible to get a hard copy of this presentation emailed? I think so. What I will do is I'll give you my contact information at the end here, and I will, if that's how CSI does it, I can either forward it to CSIA to distribute, or I can distribute to individual participants who would like it. I'll leave that up to them. But in order, I'll probably show this. It's better illustrated if I jump forward to some of the, an example here. Well, here's a great example. This first example here with receivables. The collection issue probably illustrates this person's question the best. So we had receivables at the beginning of the period starting out 0. At the end of the period, they billed an amount, but they still haven't collected $1,700. So note that $1,700 that's still out there to be collected, that's not cash in your bank. The way that's illustrated on the statement of cash flows is receivables increased by $1,700. The way to think about that is a cash used in operating activities. So hopefully that answers the question. If you have another question, I'd be happy to address it in more detail.
Hey, Craig, this is John. With regards to the slides, if you will email those to Bob, he can get them posted next to the recording on the CSIA website. So when folks go to download the recording, the slides will be available there also.
Okay, I will do that. And if that's okay with the person who addressed the question, hopefully that will answer it.
Okay. I haven't had any feedback to the contrary. It usually works for folks.
Yep. Okay. Well, again, I hope this is my first time doing a webinar. I do continuing education on a regular basis, but it's always with live people, so I've never done this before. It actually worked out really well. Hopefully, for you as participants, you were able to gain something from it. If you're interested in learning more about this, I guess contact the organization. We can see if we can set up additional webinars. Or I know that my business partner, Kathy Durham, will be doing a presentation at the upcoming annual conference in Florida in May. I believe she'll be talking about business valuation. So if you have any additional interests in learning more about accounting for small business owners or business valuation owners, stay tuned or provide feedback to the organization. We'll see what we can do.
Very good. Thank you, Craig. Yeah, this is Bob Lowe, Executive Director. Kathy's presentation at the conference last year was like, what drives the value of my company? And in the upcoming conference, she's going to talk about what action steps can be taken to actually increase the value of a company. It's funny, we get comments that, why do we have presentations on selling a company when our association is to help a company, grow and become stronger? Well, at some point in time, every owner wants to move on, and so we have to acknowledge the fact that we do have some CSIA members who, do want to, move forward with selling their company. So it's and it takes sometimes many years to prepare a company for sale, and you don't wait till the final hour to decide to make appropriate changes. You need to do it over a period of many years. So being educated on what increases the value of a company is very critical at any point in time. So
we call that as preparing your business for sale, or window dressing, as they say. Mm-hmm. I did get one more question in here. Okay. It's how can we highlight our intangible? Oh, and before I jump into that, I'll add one other point. It's not just selling your entire business. For a business that's growing, oftentimes you will want to add additional shareholders or partners. And so a valuation exercise doesn't necessarily have to be what is the value of 100% of my company. It can be what is the value of a 25% interest for someone to buy in, or a 33% interest. Flip side of that is you're not getting along with your business partners and you need to buy them out. What is the value of a 50% interest or a 25% interest in our company in order for me to buy out my partner who either wants to move on or retire, or we don't want to work together anymore? So the question here posed, how can we highlight our intangible assets to investors? Well, that can be difficult. Probably the best way to do it is to have your company valued by a business valuation firm. And what we do, especially for a company that's a going concern, you can look at the value on your balance sheet, and as I mentioned earlier in the presentation, your net asset value is not necessarily the value of your company because it leaves a lot off the table, especially for a business that's an ongoing concern with a lot of intangible value. When we do business valuations, there are three specific methodologies that we look at, and one is the asset method, which we talked about, used primarily for a controlling owner in a liquidation scenario. Another method that we use quite often is called the income approach, and we look at the cash flows that the business will generate in the future, and that's why I spoke so much and so highly about cash flows in this presentation, is because if I'm an owner of the company, what it's done in the past is interesting, but I'm interested, if I'm putting my money into the company, I want to know what kind of return on investment I'm going to get in the future. And that return on investment is going to be a combination of A, any cash distributions that can be put out by the company year after year, plus where I think the value is going to be in the future. And so when we value a company specifically using the income approach, that intangible asset value will be captured. Then we can go that one step further and try and, and the intangible value will essentially be whatever the value of the business is, the fair market value, let's say, over and above whatever the book value is. That is collectively the intangible value, which can be made up of any number of categories, including workforce in place, trademarks and trade names, patents and other intangibles, goodwill. Any of those categories can be part of your business's intangible value, and that is something that we do as a firm. We not only value businesses, but we can identify the specific intangibles. The third method that's often used in business valuation, and I don't want to step on Kathy's toes here for the upcoming presentation, but it's the market approach, where we actually compare, or attempt to compare the subject company to other comparable companies, either in terms of publicly traded securities or actual transactions that have occurred. Hopefully that answers the member's question. If they have any other questions, I'd be happy to address them.
I have a question for you, Craig. You often said cash is king for small business. What is small? We have several members that exceed $50 million in revenue. They're very sizable system integration companies. And is there a point in time where cash is not as important?
I would say cash is not as important. When I say small, it's somewhat collective. We kind of look at it as small to medium. For valuation purposes, we focus on the closely held company as opposed to publicly traded, which I'm sure most of your members are. And so, we think of small to medium in terms of not being publicly traded, and we certainly value companies with revenues of in excess of $1 billion, but yet they're closely held. So small is not necessarily well-defined. I probably should have said closely held versus small. At what point doesn't cash matter? I think cash always matters, but I think once you get into the realm of very large size or even publicly traded, you have the ability to tap the public equity markets, and you can issue public bonds. You've seen, a lot of companies, GE and Pepsi and a lot of those other companies, they can actually issue corporate bonds, and people in the marketplace will buy that. Closely held companies don't have that option. If they need to borrow money, they have to go to the bank, or they have to have it loaned from somebody. Or investors need to put it in. So I think once you get up to the point where you can actually tap the public markets for financing, that's probably when cash is less applicable, but obviously cash still matters.
Okay, very good. Thank you.
Hey, Craig, this is John. I had one question. Early on, you talked about watching for dramatic changes. And I realize that's going to vary from business to business, but are there general rules of thumbs, maybe percentage deviations from the norm, that should be red flags to the business owner when reviewing their statements?
Well, it's a situation-by-situation basis. I would say, going back to this example here, this change here, not collecting the receivables, is a pretty dramatic change. If I'm the business owner and I'm looking at my financial statements, I had a great period in terms of my statement of operations, $600 of EBIT. Yet, oh my God, I'm in a cash crunch. Why is that? If you looked at your statement of cash flows, you could figure out why. It's not because we spent excessively on property and equipment, so check that off. It's not that we paid down our loan early. We have the standard amount of debt service. We actually held off a little bit on paying our bills, so that's good. So why are we in a cash crunch? Well, the obvious sign points to this receivable amount here. We haven't done our collections. Is there a percentage change? I guess that kind of depends on how refined you want to do it. in my background, in my previous history, I did some auditing for public accounting, and I guess kind of a general rule of thumb in order for a first passover was, did something change by greater than 10%? And obviously this is an extreme example because it changed from $0 to $1,700. And there could be reasons why something increased or decreased by greater than 10%. You know, perhaps your business volume increased by over 10%, in which case you would expect that your receivables would increase along with your payables. So I guess it's on a situation-by-situation basis, but I guess the way to look at it is, if something is odd, you know, I had a great year in terms of work, I'm out of cash, why is that? Well, scan your statement of cash flows, and this is what shows up.
Thank you, Craig.
All right, I think we might want to bring it to a conclusion at this point. So to all of our attendees, I want to thank you for your participation. My hope is that you have several takeaways that enable you to make actionable sense of your financial statements. Craig, thank you very much for your contribution of time and expertise. Your presentation was really very insightful, and we wish you the best, and we'll report back to Kathy that your presentation was stellar. Thanks again to our host and sponsor, Software Toolbox, particularly John Weber, the president, who you've heard many times today. He's very kind to CSIA. I want to also, to our attendees, be sure to complete the survey for today's webinar. It will arrive in your inbox within the hour and takes only about 30 seconds to complete, and your feedback is really necessary for our continuous improvement. So in closing, here's kind of a quick bullet list for you. November 13th is a webinar on project time and material accounting. The presenter is Don Roberts. He's a CSI industry consultant. He's also a CSIA auditor, and many of our members know him. This was a hugely popular topic at our conference back in April, so we're continuing with providing information and support on the project of accounting for the time and material in projects. A couple other brief items. CSIA now provides our members with quarterly economic updates from Alan Bulu of ITR, which is Institute for Trend Research. Most of you know Alan from our conferences. And secondly, CSIA now also provides our members with quarterly ARC Advisory Group Automation Index reports. Many of our members know who ARC is, and we've entered into a contract with them, and they will provide us with these automation index reports. And these reports provide the status of the automation market, including reports on the major global automation vendors. And both of these are newly added benefits for CSIA members. Another bullet item, participate in the CSIA statistics program that was described by Craig, and also in addition to the financial information, there's also a salary survey that you can participate in, and that salary survey enables you to compare what you pay your employees in comparison to your peers, and that knowledge can save you lots of money, and it works both ways. And lastly, the very last item is, we've mentioned it before, and that is the 2013 CSIA Executive Conference is planned. It's an exciting program. Information and registration will be open in January, but save the dates. They are May 1 to 4, 2013, and it's in St. Petersburg Beach in Florida. So, point of information is that today and most CSIA monthly webinars are archived at controlsys.org. That's our public website for CSIA. And finally, if you have a suggested topic for a webinar in the future, include your suggestion in your survey comments. So this is Bob Lowe, CSIA Executive Director. Thank you again for attending, and goodbye.